I said something yesterday on Bloomberg television that I want to explain directly to you. I said we are right now rising close to the same level as 2000 and the same level as 1929. Not similar to those levels, the same levels, the levels that preceded the two most catastrophic stock market collapses in modern American history. The 1929 crash that wiped out 89% of the market's value and ushered in the Great Depression, and the 2000 crash that destroyed 78% of the Nasdaq and ended the retirements of millions of Americans who had been told the market only goes up. I am not saying the crash happens tomorrow. I am not giving you a specific date. What I am telling you is that my proprietary bubble indicators, the same indicators I have used to identify every major market bubble in my 50-year career, are now registering readings that match those two historical peaks. And I need to tell you something else. I said that most of the coverage buried. China can crash this market overnight without firing a single weapon, without a military conflict, without any of the dramatic geopolitical events that investors typically prepare for simply by making one statement about Taiwan. Let me explain exactly what I mean, because this combination, bubble valuations plus a single foreign government's ability to trigger a crash, is the most dangerous market configuration I have seen in my entire career. Stay with me through every single minute of this video, because at the halfway point, I am going to show you exactly how the chip blockade scenario works, why it would be the fastest market crash in history, and what you must hold before it happens rather than after. Do not skip ahead. The bubble context makes the chip blockade danger clear. You need both pieces. Subscribe right now. What I am about to share is based on my statement to Bloomberg Television published yesterday and on 50 years of studying how markets at bubble valuations respond to sudden shocks. Let me start with the bubble indicator reading, because most people hear bubble and think it means prices are high. That is not what my indicator measures. My bubble indicator measures 5 specific conditions simultaneously. Valuations relative to traditional measures. Conditions being sustained by unsustainably rapid growth. New buyers who have entered the market attracted by rising prices rather than fundamental analysis. Bullish sentiment so broadly held that essentially nobody expects prices to fall. Purchases being financed by high leverage. When all 5 conditions are present, simultaneously the indicator reads at bubble levels. And right now, 4 of the 5 are present in the American equity market in ways that match the readings I recorded in late 1999 approaching 2000 and in mid-1929 approaching the October crash. The valuation condition is the most visible. The S&P 500 is trading at price-to-earnings ratios that I said yesterday are close to the same levels as 2019, not slightly elevated, not historically high at the specific valuations that in every case I have ever studied preceded catastrophic repricing. When you pay 35 times earnings for a company, you are saying that company will grow its earnings at extraordinary rates for an extraordinarily long period of time. That assumption leaves almost no room for disappointment. And the economic environment I have been describing, the stagflation, the debt pressure, the slowing growth, the geopolitical uncertainty, is an environment that historically produces disappointment. The sentiment condition is equally striking. When I survey the financial landscape, I see the same broad optimism, the same near universal conviction that technology will solve every problem and that AI will generate returns sufficient to justify every valuation. That I saw it in late 1999 when investors believed the internet had permanently changed the rules of investing. They were right about the internet. They were wrong about the valuations, and the people who held maximum technology exposure into March 2000 paid for being right about the technology with being wrong about the price. Now, I need to stop here and tell you something personal, because the weight of what I am about to say requires some context. In 1982, I sat in an empty office with nothing. I had borrowed $4,000 from my father to pay my family's bills. I had publicly predicted a depression and been catastrophically wrong about timing. That failure taught me the most expensive lesson of my career. Being right about direction and being right about timing are two completely different things, and the cost of being right about direction at the wrong moment can be as devastating as being simply wrong. I am not telling you to sell everything today. I am telling you that the risk profile of holding maximum equity exposure right now is the worst it has been since I watched those same bubble indicator readings peak in 1999 and in 1929. And something I said yesterday that most coverage missed makes that risk profile significantly more acute than it was even last month. China can crash this market overnight. Here is exactly how I said it clearly on Bloomberg. It is entirely within the power of the Chinese government to basically say, let us put a blockade on ships from Taiwan. And if it says that, which it entirely could, the market would go down massively immediately. Let me explain the mechanism precisely, because I think most people who heard this as a sound bite did not fully absorb what it means. Taiwan produces approximately 90% of the world's most advanced semiconductors, the chips that every AI system requires to function, the chips that every data center requires to operate, the chips that every smartphone, every laptop, every modern vehicle, every piece of military equipment depends on. There is no short-term substitute. There is no factory elsewhere that can produce these chips in the volumes that the global economy requires. Taiwan's semiconductor manufacturing company is the single most critical choke point in the entire global technology supply chain. China controls the waters around Taiwan. China has the military capacity to impose a naval blockade that would prevent chip exports from Taiwan within hours of a decision to do so. And China does not need to actually invade Taiwan to produce a global economic shock of unprecedented severity. It needs only to credibly threaten to block chip export. The mere credible announcement of that intention would be sufficient to trigger what I said on Bloomberg. The market would go down massively immediately. Now, think about what massively immediately means in the context of a market that is already at bubble valuations. At normal market valuations, a sudden severe shock produces a correction that is painful but recoverable. The market falls 20 or 30%. Investors who hold through the correction eventually recover. The shock reprices the market from slightly elevated levels to fair value, and the damage, while real, is manageable. At bubble valuations, a sudden severe shock produces a crash rather than a correction. Because at bubble valuations, the market is not just slightly elevated above fair value, it is dramatically elevated. And when the shock arrives, it does not just reprice from elevated to fair value. It reprices from elevated through fair value to distressed value as the selling that the shock triggers overwhelms the buying that might otherwise provide support at fair value levels. In 1929, the market was at approximately the same bubble indicator levels I am seeing today. The crash that followed did not stop at fair value. It fell 89% over the following 3 years as the initial shock triggered a self-reinforcing spiral of selling margin calls, bank failures, and economic contraction that fed on itself until there was almost nothing left to sell. I am not predicting an 89% crash from current levels. I am saying that the combination of bubble indicator readings matching 1929 and 2000 with a specific identified mechanism, the chip blockade scenario that could trigger a sudden severe shock, creates a risk configuration that demands a different portfolio response than most investors currently have. Now, let me tell you exactly what that different portfolio response looks like. The first response is to honestly assess how much of your current portfolio is concentrated in the technology and AI-related stocks that are most responsible for driving the market to current bubble readings. These are the stocks that are most overvalued relative to their current earnings. They are the stocks whose valuations require the most perfect execution of the most optimistic AI revenue projections. And they are the stocks that would be most devastated by a chip blockade scenario that disrupts the AI infrastructure supply chain on which every AI company depends. I said on Bloomberg that AI is in the early stages of a bubble based on my bubble indicator. The companies I am referring to are trading at valuations that require AI to generate revenues at a pace and scale that is dramatically faster than most AI companies are actually delivering. When the gap between the valuation assumption and the actual delivery becomes visible to the market, the repricing will be severe, and a chip blockade that disrupts the entire AI development trajectory would make that gap visible overnight. The second response is gold. I have recommended it repeatedly. I have 75% of my personal family office in gold-related instruments, and I want to explain specifically why gold is the right response to the bubble plus chip blockade risk configuration rather than the standard arguments about inflation hedging. Gold performs well in market crashes when other assets are falling, precisely because it is the asset that investors run toward when they are running away from everything else. During the 2008 financial crisis, when the S&P fell 57%, gold rose 25%. During the initial COVID crash in March 2020, gold initially fell with everything else and then recovered dramatically while equities were still finding their bottom. In a chip blockade scenario that triggers a sudden severe market shock, gold would be the primary beneficiary of the flight to safety that follows GLD and IAU through any standard brokerage account. The third response is cash, not as a permanent holding but as a strategic reserve. In a crash at bubble valuations, the forced selling that follows creates buying opportunities at prices that are only available to investors who have cash to deploy. The investors who were fully invested at the 1929 peak had no cash to buy the extraordinary assets that became available between 1930 and 1932. The investors who had cash built generational wealth during that period. A meaningful cash position right now, uncomfortable as it feels when the market is still rising, is the position that gives you the ability to be a buyer when the bubble repricing creates the opportunities that only appear at the bottom of crashes. The fourth response is to understand the timeline I flagged yesterday. I said the window between the 2026 midterm elections and the 2028 presidential election is a period of particular vulnerability. The debt pressures and political conflicts over taxes and spending will converge during that window in ways that add fiscal pressure to the geopolitical pressure of the chip blockade risk and the market pressure of the bubble valuations. That window is now less than 4 months away. The 2026 midterms are in November, and the period I flagged as particularly vulnerable begins the day after those results are announced. I said yesterday that the stock market is approaching 1929 and 2000 bubble levels. I said that China can crash this market overnight with a chip blockade announcement. I said the window of particular vulnerability begins in November 2026. These are not predictions. They are the output of 50 years of studying how bubbles end and how geopolitical shocks interact with overvalued markets to produce the worst possible financial outcomes for ordinary investors who were not positioned correctly before the shock arrived. The bubble indicator is at the same reading it had before 1929 and 2000. The chip blockade mechanism exists and is entirely within China's power to execute. The vulnerability window begins in 4 months. What you do with that information today is the most important financial decision you will make this year. If this video made you see the current market differently than you did before you started watching it, hit that like button right now. Subscribe to this channel because we are tracking every development of this together in real time, and leave one honest comment below answering this question. When you heard that China can crash the stock market overnight by announcing a chip blockade on Taiwan, did you already know that was possible? Write yes or no below. I read every single comment personally, and I will see you in the